Alright guys, so let's talk about the Middle East. Just yesterday, we said that the US was gonna escalate things, and guess what? It did happen. Because of the strikes on US bases, America has launched their own counter-strikes. We are caught in this endless escalation loop where there's no escape. Iranian proxies strike the US hits back, and now we are in a very weird proxy war. In our lead story today, US strikes Iran-backed militia in Iraq after attacks on base. Lloyd Austin, he's back. He is out of the hospital and he just unleashed more attacks. The operation occurred as the US and UK have been conducting an air campaign against the Houthis in Yemen. So the airstrikes are starting to pile up across the entire Middle East, and you best believe things will keep escalating. Neither side wants to back down, and until Israel agrees to a ceasefire, Iran and friends are going to keep striking back. And this is fast becoming a daily event. If we look at the numbers, it's really staggering. There have been over 150 attacks against US forces in the Middle East. It's not just the proxies hitting US bases, Iran themselves are hammering their neighbors as well with missiles. There were attacks in Syria, Iraq, and most recently Pakistan. You can see how far this conflict is starting to spread. The problem with US strikes is how it really antagonizes the militia, especially the Houthis. The real threat to the Western economies isn't the strikes on land but the Red Sea. And whether they know it or not, the Houthis are creating a new inflation nightmare for the West. December inflation rebounded in both the US and the UK, which is the real threat that the West is facing. And that's possibly why David Cameron is heading to the Middle East to push for Gaza ceasefire. The British Foreign Minister wants to arm twist Netanyahu to end the war because the UK economy is in stagnation. What's happening in the Red Sea is starting to hit the pocketbooks when you have a shipping disruption on such a massive scale. The inflation rebound we saw back in December will continue into Q1 this year. If we look at the US CPI, the inflation fight has effectively stalled. Headline inflation today is at 3.4%, higher than back in June last year. Core inflation has not moved at all since October as well. The longer this state of affairs continues, we'll start to see people back in the West start to get really pissed off. So even though there are hawkish elements back in the West clamoring for a war, we are seeing many others slowly wake up to the reality, right? Repeated rounds of retaliation strikes by the US and allies haven't stopped the assaults by the Houthi militants. Sailors are demanding double pay, issuance rates are flying up, and 12% of the world's seaborne trade is now compromised. The big issue here is the increase in shipping costs across the board. Even if the ships aren't going through the Red Sea, overall prices are starting to fly up. We live in a just-in-time world, right? When you add 10 days to a voyage, it's not just time delays or extra fuel costs. Those problems are bad enough, but now we have lower turnover as well. There aren't enough ships around on both the tanker and container side. Since October last year, shipping costs have doubled and tripled from Asia to the West. Whether you're moving goods from China to Europe or the US, you're going to have to pay much more now. And this is going to add more upward pressure to inflation. We know central banks today are desperate to lower interest rates because if they don't, many economies, especially those in Europe, will enter a recession. But there's a good reason why central banks don't dare promise aggressive rate cuts in Q1 or even in Q2. They know that supply side inflation is still an enormous risk. The ECB is warning of supply chain bottlenecks as one of the risk factors that could cause a rebound in inflation. And that could cause them, as well as the Federal Reserve, to delay the schedule of rate cuts. Now, market is pricing in a ton of rate cuts today, and we are only just in January, and that's why the stock market, the S&P, has hit an all-time high. Goldman Sachs sees 4 Fed rate cuts and 2% inflation for 2024. They expect a good year in risk assets because rates are going to come down fast. But if the Red Sea crisis continues, we could see a big rug pull in stock prices. The crisis we face isn't just in container ships moving stuff from China to the West. We have to factor in the higher cost of shipping oil and gas as well. Shipments from Saudi Arabia and Iraq are already starting to divert around Africa. And as we said before, it's not just higher costs but fewer shipments heading to Europe. Over 9 million barrels have been diverted so far. The Middle East accounts for over 30% of global oil production, and when shipping costs go up here, it's a very big problem. The cost of transporting fuel from Japan has gone from $30,000 a day to over 80 grand. From the Middle East to the Netherlands, costs have tripled from 20k to over 70k easily. So if you're heading around Africa, that's at least $500,000 more to transport fuel, and that's going to bleed into the final price tag at a pump. I think you can see where this is going. Inflation could stay sticky for at least one more quarter, and there's a chance of zero rate cuts in March. And while the Red Sea threatens a global inflation crisis, there's one economy that's already collapsing, and that's of course Argentina, which shouldn't be a big surprise here. Ever since Milei got into office, he has been imposing draconian measures, and that includes cutting thousands of government jobs and trying to privatize every industry in the country. And a big shout out to our sponsor today, Zbiotics. We have busy lives these days, and we can't afford to waste a day stuck on the couch because of a few drinks the night before. Zbiotics might be the answer we are all looking for. Zbiotics pre-alcohol probiotic is the world's first genetically engineered probiotic. It was invented by PhD scientists to tackle rough mornings after drinking. And here's how it works. When you drink, alcohol gets converted into a toxic byproduct in the gut. Is this byproduct not dehydration that's to blame for your rough next day? Zbiotics pre-alcohol probiotic produces an enzyme to break this byproduct down. It's designed to work like your liver, but in your gut, where you need it the most. If you plan to have a drink, taking Zbiotics beforehand will help you feel your best tomorrow. As we head into 2024, you don't want to lose a beat while taking a swig. In the pack, you'll find a booklet that tells you how to use, how it works, and the technology behind the product. So say goodbye to miserable mornings after drinking. Go to zbiotics.com/seanfu to get a 15% off your first order. However, Argentina has now officially entered a recession. Q2 GDP came in at minus 4.9%, while Q3 recorded a 0.8% drop. 2 quarters of negative GDP means a technical recession, and this places Argentina in a period of extreme austerity. People will get poorer and the economy will contract for some time. Because of Milei's big reforms, a lot of jobs will go away. That means consumption will also collapse within Argentina. The idea here is to counter inflation by destroying demand. There's a big inflation problem today, over 200%, and it's only going to get worse. Just in January alone, the peso has collapsed by another 30% against the US dollar. A dollar will get you around 900 pesos a month back, but it's nearly 1,300 per dollar today. That's a big devaluation that's hammering away at people's buying power. This is the blue chip dollar swap rate, or the unofficial market. It's the true exchange rate of the Argentine peso, and it's showing that the currency even today is still overvalued. There's a long way more for the crash to happen. Sooner or later, Milei will have to devalue the official exchange rate again by at least 50% if he wants to keep up with reality. He can't hike rates anymore because no one takes the peso seriously. He can't do capital controls either because the world demands dollars from Argentina. That's what happens during a currency collapse. Confidence goes out of the window. So the only route left is through the storm. Milei is betting on getting enough dollars from the IMF and his reforms working before the entire economy crashes completely, which is becoming a real possibility. From Bloomberg, Argentina's economy posted mild contraction amid runoff election. Economic activity fell by 1.4% in November, signaling a further contraction in output. Since the start of 2023, Argentina's economic activity has been getting worse. It has gone from positive to negative territory. And it kind of tells us that the country's output is less than what they take in. Argentina isn't producing enough for the world, and it's a big reason why they are in a recession. And when Milei says that things will get worse than better, he's absolutely right. The next set of policies he's unleashing is going to ramp up the pain. While other countries are looking to reduce income tax to spur economic growth, Argentina is forced to do the complete opposite. Milei seeks to increase number of Argentines paying income tax. The income tax floor is going to get lowered. More people will be paying more taxes soon. According to the proposal, individuals making more than 1.3 million pesos or 1600 US dollars a month will be subject to the income tax. And that doesn't sound like a lot, but the average income in Argentina is less than 500 US dollars a month. So Milei is going to tax the upper middle class more to increase government revenues. Once again, it's the demand destruction playbook to combat inflation. People will get poorer in the interim and GDP will continue to drop. So you can see how bad things can spiral out of control during a currency collapse. We have to get prepared because no country is 100% immune to this. Let's shift to China and talk about the stock market sell-off now, because things are starting to reverse. But we have to be careful about what's going on. This might not be sustainable. China weighs stock market rescue package backed by $278 billion. Now this is big news. It sent Chinese stocks back up by almost 4%. Beijing might be about to activate offshore money for stabilization fund, which could happen as soon as this week. Major economies like the US and China, they all have this plunge protection team, right? The team goes into the market and buy up a ton of stocks to prevent a total collapse. Back in 2018, Trump activated Wall Street to bolster US stocks when the markets were crashing. It's nothing new, and it seems that China is now activating theirs. Policymakers are seeking to mobilize 2 trillion yuan to buy shares onshore through the Hong Kong exchange. It hasn't happened yet, but just the rumor of this has sent prices shooting up over the past 24 hours. Now, to make this clear, right, I'm not a fan of government intervention in the markets, doesn't matter if it's the US or China doing it. These kinds of interventions are band-aid which rarely last. When the plunge protection team goes in, it is not sustainable in the long run. It will depend on the overall growth of the economy. So don't be surprised that if this intervention has limited success, you need to invest based on the fundamental health of the economy and not just government interventions. Personally, I'd rather if China doesn't do this bailout and flush out the weak hands from the market. By propping up the market now, investors could actually sell into the rally and undo the effects of the 2 trillion yuan. President Xi has signaled time and time again that he isn't focused on the markets, so prices aren't that important now. The old playbook of whether there's growth weakness, you stimulate the property market or build infrastructure, that's no longer relevant. China's going to continue the controlled implosion of the property market. It's going to happen sooner or later, so Xi Jinping is doing it now. And because real estate is at least 25% of the economy today, there's still more pain coming in the next year or two. So don't expect a strong recovery for a couple of years. So I hope you go into this with open eyes if you do decide to invest in China. You're buying at a time when the bubble is still deflating and other sectors are growing, and this weakness could continue for a while longer. Top economist Al Arian also believes China's doing a big pivot and there won't be a return to real estate anymore. If you simply crank up this engine that's becoming less efficient, it will produce less in terms of growth, it will produce low quality growth, and it will have adverse side effects. If you want quick returns and hope for a big jump, China isn't for you. You lose your mind because a real stimulus coming for the Chinese real estate isn't coming. Now, that's not to say that China is uninvestable, right? Ray Dalio's Bridgewater is now bullish on Chinese stocks because valuations are insanely attractive. Chinese stocks are trading at a big discount versus US equities, so the risk to reward is there. On a fundamental basis, investing in China does make sense. But if you think this bailout will work, I have bad news for you. It might lift up the markets for a bit, but it won't last for long. Back in 2015, China tried to rescue the markets with a 1.5 trillion yuan bailout, around $200 billion worth. Prices jumped up a bit, but ultimately went down. This is money used to buy stocks and not stimulus directly injected into the economy. There's no change in underlying consumption. The same thing is likely to happen if China launches the bailout today. So if you're hoping for this to suddenly push Chinese stocks up by 10 or even 20%, it likely won't. I'll be happy if it does, right? I have investments in China as well. But we have to be objective here. Look at the reality. Valuations might be cheap today, but the recovery will take some time. But let me know what you think in the comments below. How long will China's recovery take? And is the US moving closer and closer towards a complete war in the Middle East? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.